Hi everyone, this is a technical analysis on USDJPY. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting, with basically no change to the statement. Fed Chair Powell stressed once again that they are proceeding carefully, as the full effects of policy tightening have yet to be felt. The recent US CPI missed expectations across the board, bringing the expectations for rate cuts forward. The labor market is starting to show weakness, as continuing claims are now rising at a fast pace, and the recent NFP report missed across the board. The US consumer confidence and University of Michigan consumer sentiment continue to fall. The latest US ISM manufacturing PMI missed expectations by a big margin, followed by a disappointing ISM services PMI, although the latter remained in expansion. The recent US retail sales beat expectations, while the US PPI missed forecast by a big margin. The recent Fed speak has been leaning on the hawkish side, but last week's inflation report pretty much confirmed that the Fed might be done for the cycle. In fact, the market doesn't expect the Fed to hike anymore. In Japan, the BOJ kept its monetary policy basically unchanged at the last meeting, but formally widened the yield curve control to 1% on the 10-year JGBs, stating that it will be a reference cap. Governor Ueda repeated once again that they won't hesitate to take easy measures if needed, and that they are not foreseeing sustainable price increases. The Japanese CPI showed that inflationary pressures remain high, with the core reading hovering at the cycle highs. The latest unemployment rate remained unchanged near cycle lows. The Japanese manufacturing PMI matched the prior reading, remaining in contraction, with the services PMI falling but holding on in expansion. The latest Japanese wage data beat expectations. And as a reminder, the BOJ is focusing on wage growth to decide whether to tweak its monetary policy. The market expects the BOJ to keep interest rates unchanged at the next meeting as well. Now, on the daily chart, we can see that USD JPY rolled over exactly from the cycle high at 151.94, as the US data showed more weakness, especially on the labor market side. The divergence with the MACD was already signaling that the momentum was weakening. In this case, the US data was the catalyst for the correction lower. We can expect the sellers to target the trend line here around the 146 level, which is also where the buyers are likely to pile into position for another rally, targeting a break above the cycle high. On the 4-hour chart, we can see that the price bounced here around the 147 handle, and it looked like it's heading for the 150 level again. That's where we can expect the sellers to step in with more conviction, as they will have the confluence with the trend line, the 61.8% Fibonacci retracement level, and the previous swing low. The buyers, on the other hand, will want to see the price breaking above this trend line to increase the bullish bet into the cycle high and above. On the 1-hour chart, we can see that the price recently diverged with the MACD near the 147 handle, and as the moving average crossed over, the buyers turned bullish, with more buyers piling in to target a correction into the 150 handle. We now have a minor trend line here, which will be key for this correction. In fact, we can expect the buyers to lean on this trend line in case the price pulls back, to position for the continuation of the rally into the 150 resistance. The sellers, on the other hand, will want to see the price breaking lower to pile in and target the 146 level. Today, we will get the latest US jobless claims report, which is probably going to be the most important release of the week. Tomorrow, the US will be on holiday for Thanksgiving Day, and therefore the liquidity in the market will be thinner. On Friday, we conclude the week with the Japanese CPI data and the US PMIs. Weak US data should be bearish for the USD/JPY pair, as Treasury yields are likely to fall further. On the other hand, strong figures should support the current correction and lead it to new highs.